Thanks for joining us for the executive series. Today I'm talking to Don Hamson, who is the Managing Director of Plato Investment Management and also the Director of the PL8 Fund. It's good to talk to you, Don.
Good to see you, Tom.
Now, let's talk about the PL8 Fund in particular. Since the reporting season, it's been travelling quite nicely. In particular, you've just announced the first dividend.
Yeah, so we just announced first three dividends, actually. The first three dividends, because it is a monthly paying LIC, which is pretty unique. In fact, I think it's the only LIC that pays monthly dividends. And so we announced the first three payable end of October, November and December, 0.45 cents per share per month.
Yeah, and now that, as you rightly say, gives you a particular place in the investment universe in Australia. How have investors responded to that monthly income stream?
They've responded very well. I mean, we basically sold all the capacity in the LIC, and I think a lot of mums and dads, retirees, which is what its target audience are, want that regular monthly income. If you're retired, you don't get your salary paid every month or fortnight, which you used to. There's not many things that pay monthly dividends, so there's quite a lot of interest in it because it does pay monthly income, and you can get that hitting your cash account each month, and it's there for retirees to live off.
And you've also paid particular attention to taking a conservative approach to expectations around the dividend as well.
Yeah, look, the board was conservative in setting the 0.45 cents. I think it gives us some room to lift that dividend over time.
And another important element of the thinking, at least, is how do you maintain the right sort of exposure to the right sort of stocks over time to make sure that you're not caught out in those months where perhaps income from dividend payments might be a bit on the lighter side of things?
Yeah, first we have a well-diversified portfolio, around about 100 stocks. But to get the high income in the market, so our objective is to get higher income than the market, we actively trade stocks around dividend events. So we're not sitting overweight all the banks all the time to get those big bank dividends. What we do actually is we're overweight, say, CommBank in August, and then after it goes X, we may actually trade out of it and move into other banks that go X this month, for instance. So by actively rotating through banks, we're not overweight all the banks all the time, but we're getting as much income as if we were overweight all the banks all the time. So we haven't got that big bank exposure, and there's times when bank levies come in and those sorts of things, all the banks get sold off, so we're not overweight those banks.
Okay, so
in total.
Why don't we step back a little further and just take a bird's eye view of the market and what your view of things is since the reporting season. Have there been any thematics that have changed direction or been tweaked or anything that's informed your investment philosophy?
Yeah, so I think a couple of the themes out of the reporting season was it was a very strong result for resources, and in fact we saw big dividend increases by BHPs and Fortescues and Rios and those sort of things, and Rios recently subsequently announced a buyback. So they're doing well, although we have seen iron ore prices tip off a little bit, so it's always a shorter term thing. Another big theme which came through from some of those resource stocks, but also widespread other costs, and I think retail, mums and dads are finding it as well, is that energy prices are biting, and they're hurting companies as well as individuals. No surprise though that AGL had a pretty good result. It increased dividends by 39 cents. We know 39%. We know where those higher electricity prices are going.
Indeed.
Obviously, there's a lot of political pressure, etc. But it is affecting companies. It is potentially crimping earnings going forward. But it does make stocks like Woolworths, which had a pretty good result and increased dividends, albeit it cut it last year, but increased them by 50%. But their commentary was we need to think about whether we put solar panels on the roofs of our stores to generate our own electricity, and also refocus on energy efficiency, change to LED lighting and those sorts of things, so that they're being careful about electricity they use, which is a good thing.
Yep.
The bad thing is prices are high, but it is forcing people to seriously consider, because it's economic to do those sorts of things. But it was resource stocks, Woolworths. The REITs themselves, Stockland's looking at potentially putting photovoltaics on top of their sort of thing. So that was a big underlying feature. But generally it was a positive reporting season. We saw the index as a whole, dividends increased by about 30 basis points. So the yield on the Australian market is around 6%. The increase at an index level was about another 0.3% on top of that, which is quite nice. It's the likes of BHP, Rio, all the miners, Woolworths, IAG, Wesfarmers all had strong, healthy increase in dividends. I think there was a bit of a focus on one or two stocks that disappointed for various reasons. CommBank obviously had its issue in Austrac, etc. But it's actually a pretty good result for CommBank. They raised their dividends 4%, earnings were up 5%, and we think that the price is well, all the problems are reflected in the price, or more so. We actually think it's probably a cheap buying opportunity for CommBank at the moment. I think that this ongoing thing is not going to, Austrac's not going to have an ongoing issue with it. Telstra, on the other hand, was the other big disappointer, and it announced it would cut next year's dividend by about 30%. Now, that's a big thing. A lot of people own Telstra, and they got hurt if they owned Telstra as the only stock they held. But if you look at our portfolio in August, it was basically flat. So we had overweight positions in CommBank, we had overweight positions in Telstra, but other stocks did better, and overall our portfolio was flat. A little bit behind the market, but only like 1%. But if you had all your eggs in Telstra and CommBank, you lost only 10% in August. So it shows the benefit of a diversified income portfolio.
Indeed, it does. Don, it's been great talking to you. Thanks for your time.
Okay, thank you, Tom.
And thanks for joining us for the Executive Series.